Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So because of Juneteenth and the holiday on Monday, things are switched. So we're going to do EIA on Thursday, Econ today, because the EIA data and all of the federal data comes out a day later. So we want to make sure that we stay in front of you and give you the updates that we think are important. And in today's Econ show, we're going to have our normal 5 segments. Luckily, it'll be shorter than last week just because there's not as much going on after what we covered. Well, I should say there's a lot going on, but at least it can be consolidated a bit more. So in the first segment, we're going to cover global GDP estimates, how they keep falling, and what is driving analysts and just global entities starting to finally say, like, wow, global growth is really not going to be there. We want to look at different things, including rate hikes, inflation, global trade, and why those are so important when we're looking at the different pieces and who's going to benefit, who's going to lose the most when we're looking at developed markets, G7, emerging markets, and the different back and forth. Then in the next segment, we're going to go into the Fed's rate dilemma. So so for those that haven't been following us, we wrote a series of articles at the beginning of last year. And one of the ones that we wrote was that the Fed was going to be crushed by rates, and that rates were going to become the biggest hindrance for what they want to do, because the market was going to force them to act. And now the rates dilemma keeps coming back. But as rates go up and start to price in more, but what does that mean for the consumer? And that's what we really want to talk about in segment 2, because you have the rates dilemma, the Fed's reaction to it, but then what is the downstream effect? How is that going to impact the way people spend, feel, and save? Because those are very key pieces when we're looking at US GDP growth. Then in the next segment, we're going to go into the key indicators that have flipped into contraction. And remember, we've been saying that a lot of the indicators that we've been looking at have been slowing but haven't gone negative. These are some key ones that have now actually flipped negative, and the housing market continues to worsen. Then in the fourth segment on Europe, we're going to talk about the ECB's fragmentation and why that's so concerning for them when you look at the periphery and some of the different pieces, and how we continue to have inflationary pressures mounting. Then in the Asian update, instead of focusing so much on China as we have in the past few shows, there isn't as much new data on China. But there is a lot happening with the Chinese yield curve control, or YCC. And we want to explain what is yield curve control and why is that so important, because Japan in 1998 really ushered in quantitative easing the way we know it. And again, we've been saying for a very long time, as many, that there was no clear exit. And now when you start looking at rates, because the same issue that's happening in the US on rates is happening elsewhere, and Japan is one of the key ones, and we want to talk about why does that matter? Why should we care in the US? Because again, that's going to have a reverberating impact when you start thinking about foreign exchange as well as debt. So with that covered, we want to go through and quickly address some of the key pieces. And here's one of the fun ones that we want to look at, which Bloomberg, I think, does a good job of highlighting. And it's what global central banks have been doing over the past 90 days, which is raising rates. So the cumulative policy rate change in percentage points from the start. So when you look at it, you're looking at Chile, Ghana, all of these, and it's not going to be surprising to see that the top edge of this is really a lot of these emerging markets that are trying to get in front of the inflationary push. We have Peru, Ecuador, that have already seen a significant amount of protests. Colombia had I'm not going to pretend to know Colombian politics all that well, but I know that the person that came in wants to have a very socialistic bent. I don't know if it was an upset, to be honest with you, and I'd love if somebody knows to drop it in the comments. But again, you're starting to see this pivot where people are so angry, they want change and they want something to shift. And there's some concern because the public oil company is Ecopetrol is going to see the board get fired. There's concern that this new president wants to shift fully away from the oil and gas and then drive towards the green solution, which, as we know, is going to be problematic. As on a global basis, we're turning coal facilities back on because of the shortages. But again, those are some things to talk about later. But some of the key pieces here are the rates that continue to go up, and that's really driving. And as rates go up in the developed market, especially in the U.S., with the U.S. 10-year kind of setting the stage for emerging market debt, that's where you're going to see as the U.S. goes up, other countries are going to have to go up harder and faster because they're going to try to get in front of that and, again, trying to maintain that peg. And while all of this is happening, you're starting to see, again, the pressure to the downside where you have those haircuts on GDP growth estimates with the economist consensus estimates, with the world in blue now down to 3%, 3.2%, the US in orange at about 2.6%, the Eurozone at 2.6%, and China down to 4.3%. And unfortunately, even with this down move, we still think there is way more to go, especially when we start looking at the Fed, what the New York Fed has said, and how we already think the Eurozone is in a recession. So again, all of those are really going to get pulled down. And as those two gigantic entities, especially as China, again, can't right that ship, we're going to talk about global trade in a moment, which again is going to pull down those Chinese estimates, which will, again, downshift again the world growth. And a lot of that is being carried by the inflation side. And again, they're trying to get in front of it. If you look at the peak has continued to move back. Now the view is that global inflation will peak in August, with the global number being at about 9.6%. To be fair, I think that is probably accurate, where you're going to see August, as we were saying, June was really where you were going to see the last peak of that rate of change, and then it's really going to slow down as you go through July and August. It's going to slow but not stop going up. So to say that August is going to be a peak, I think is a fair assessment. Could it be September? Could it be November? Sure. I'm not saying, but my whole thing is that the rate of change is going to stop. But when you look at this chart, this is where I disagree with the estimates. I don't believe you get this big down move. I think you get more of the stagflation. So yes, when you think of the chart, the base effect helps you come down. And all that means is that the inflation was so high the previous year, when you look at year-on-year metrics, that it's naturally going to come down, which is true. My point is, when you think about inflation and what the consumer feels, and this is a global statement, the consumer, yes, the year-over-year inflation has stopped going up, but I'm still paying the higher price. I haven't seen deflation. I've just seen stagflation. And that's, I think, the bigger issue that is going to come out as we come out of the summer and start to really push into that Q4, where we think that things are going to get that much worse. Now, it's not surprising as all of these things hit, especially on the inflation side, rates going up, pressure is that global consumer confidence index is below where it was for COVID, still a bit above where where we were for the global financial crisis. But again, we still see this coming further down as the pain continues to ratchet up. And I think it's important to look at, as rates go up, I think when you start looking at real home prices, that's when you start to see the pressure really come into play. So in 2 decades during which rich country property prices soared, as anybody who's tried to buy a house in North America can attest to, it's interesting that even 10 years after its own massive property bubble began to deflate, Japanese prices were still declining for another decade or two. Real estate bubbles can take a long time to adjust. Now, we've seen, and we're going to talk about in segment 3, how quickly the U.S. market has slowed down. We think that this is going to accelerate, but the one that always stands out, and for my friends in Canada, we've talked about this before, but the Canadian market is just, insane. And there, we do think that there's going to be a much bigger drop. And even if Canada does see a big drop, it's still going to be above where things were. So again, you're getting an idea of how far some of these things have to fall to get into some of that kind of normal, I guess what you could deem as a normal place. So the global manufacturing PMI continues to move down. And when you look at the OECD diffusion index, that's where you continue to see that movement, because when you look at the 6-month leading indicators, you can see that slowing period that has now come essentially into a negative territory, and why we think that the global manufacturing PMI on a, again, global basis, when you think back to the chart where there's still growth of about 3.2% on a global basis, how global manufacturing is really going to come into contraction, and why we see more downshifting in those estimates as we progress into Q3. Because I think Q3 into Q4 is where you're going to see the biggest pivot down, and that's when you're going to start to see those recessionary numbers start to crop back up. And instead of it being the leading indicator, but the current indicators, I think that's when you're going to start to see some of those bigger shifts and some of the bigger fear. So when you look at the different pieces, the growth differential between emerging markets and rich nations in terms of developed markets, the emerging markets and the emerging economies have continued to be fairly better on the real GDP growth side. But remember, there's a lag effect. You know, the developed markets slow, and then after they slow, they stop buying. And when you start looking at the copper, and I think I forgot to put them into this show, but we'll put them into the EIA show. The LME and just the estimates of the amount of product in storage, that's copper, zinc, lead, steel, not so much steel, iron ore, have really come down. So even though we are seeing demand destruction, we're also not seeing a huge amount of supply coming in. So some of these nations that produce these products are going to be able to outperform, which is on the emerging market level. And then the others that really import a lot of things are going to see some of that come down. The bigger issue remains the food side, where you continue to see inflation. So we do believe that emerging markets will outperform on a real basis, but the distance in which they've gone, when you look at 2022, where developed economies are expected at 2.8%, EM is at 3.7%, but 2023, the gap widens. That's where we think there's a shrinking down, where you're going to see this contract, and not so much on the developed market side, though we do think there's some downshifting, but more on the emerging market component, as there is that lag piece between, which is starting to play out when we look at the different bets. So emerging market corporate bonds outperform U.S. high yield debt. And as the high yield debt goes up in the U.S., we think that you're going to see a shift in terms of where some of those investments are going. And we actually think that emerging market corporate bonds will start to get worse, especially as the dollar remains over that 102 level. You continue to see rate pressure, and you continue to see the Fed raising rates. That's going to put more pressure on the emerging market front. And that's when you start looking at, I think, a good estimate of EMs likely face more growth downgrades, which is what we've been saying. And that's when you start looking at developed markets, kind of lead the way in terms of those downgrades. And then we think that you get that bigger pivot down as well on the emerging market front. So then when we start looking at emerging markets and the outflows, you're starting to see those outflows pick up. So the daily tracker of real money flows in emerging markets in billion have actually started to come negative. And again, it starts slowly and then it accelerates. And then when you look at it, a lot of this is concentrated outside of China, which again is why we expect to see that acceleration to the downside, which will push rates up, push prices down, because remember, yield and prices are inverse to each other. So, and a lot of the reasons why, and again, remember that delay, is the world trade volume. So the 3-month moving average has moved down back within the range. It's still at the high end. I am not saying it's not in the high end, but all of the leading indicators were showing new export orders, new orders, Inventories, again, are all pointing to this moving in the wrong direction with more growth slowing, which again is going to hit emerging markets hard. And here's some of those leading indicators, because for those that have been following us, we've been talking about semiconductors, the issues there, and the semiconductor prices eased in May, and you can see that the pandemic peak, and then the American, European fertilizer prices have dipped. So you're starting to see again some balancing of it, but we just don't see a huge drop. It's just the peaks were never really going to stay, because you get that bullwhip effect where you get this massive move up, and then you start to get these slowdowns as the market tries to catch up with it. There's over orders, there's demand destruction, but you're going to see that balancing out. And that's what we see here, is some of this balancing and keeping things elevated, but again, leading more towards that stagflation and less on the deflation side. So then when you start looking at the emerging market surprise, again, because I think the emerging markets is where the most, I guess, concern to the downside, remains. Not to say that we're not going to see more pressure on the developed side, but emerging market economic surprise index has moved down again, as well as emerging market export surprise index. They're moving in the wrong direction, coming back to the pressure, because a lot of these emerging markets rely on exports for dollars coming in and additional flow, and you're not getting that, which is why we do think you're going to see more of that pressure on the emerging market front. And here's just another example of where we're seeing it, where the spot rates continue to flatline. But again, they're off the peak, but you can see that they're starting to stabilize. The Shanghai to LA is flatlined. The WCI composite is kind of flattening. And that's where it'll be below the peak, but there's still a certain amount of that's going to be built in because of diesel prices or marine gas oil, depending on which metric you want to use. Labor, all of these things are going to keep some of these prices a bit higher. Then when you start looking at growth slowing faster than expected, you're seeing it more and more when you look at global developed markets, emerging markets. And then when you start looking at the different pieces in terms of slowdowns, you can see that May into June, you saw another downshift, which is why, as we've been showing, we expect that to continue to edge lower. And one of the things is, as things edge lower, you have to look at, and this is just looking at the G7, labor shortage indexes, where you're starting to see a little bit of that slowdown. And we talked about it last week in the US. You're starting to get some announcements of layoffs, hiring freezes, and that's not just the U.S. The U.S. just happens to be on the early stage of that because we bounced back first. We had our inflation go first. And now you're starting to see that roll a bit, and again, job openings rates. It's still early, which is why the pressure we think only mounts. Which again, as this turns down, and you get wage compression a bit more, and you start to see some of those impacts, that's when we see a bit more of that pressure coming down downstream. And then the impact on interest rates and GDP shock, because I think this is not appreciated in the same way. And this is looking at lower debt countries and higher debt countries. Higher debt countries would be China, US, some emerging markets, Europe. So when you look at the pivot on interest rates, and because let's just take in the US as an example, we're not only rolling old debt, but we're issuing new debt because we're still spending more than tax receipts. So because of that, you're going to continue, as the interest rates go up, your interest expense compounds very quickly and becomes a bigger hindrance when you're thinking about interest expense and the pressure that's going to lead to on the GDP front. And this is why, again, I am by no means, I was one of the first to say stagflation was going to be the likely outcome. And we do have proof, because every one of my internal thoughts have been recorded either by video or by the written word. But again, I'm not unique in saying that, look, stagflation is here. I think it's now becoming more common ground, just given that all of the indicators, the leading indicators, the things we were projecting have come true. So now that it's come true, people are adjusting their estimates to reflect some of those new pieces. And now, some of the key problems when you look at demographics, when we've talked about it before and alluding to it, is the global decline in fertility rate. And that's where we're still right at the replacement side. So replacement is usually between 2.1 and 2.4. I know you can't have half a child, but it's just a matter of, how many people are having 3 and more versus 2 and less. Because 2 and less, you see how things kind of flatline, and you don't get the same growth and the demographic shift. And we've seen it in the US. We'll talk about that in a minute. And we've seen it, the biggest hit that we're seeing it is China. China has that huge demographic problem that is only compounding as we go forward due to the one-child policy, which, as you can see, is obviously bringing down that growth and that mismatch between male and female. But it's not just China, it's not just the US, it's a global problem, which again is going to shift those demographics. And here's when you start looking at the US. The U.S. lacks working age population. Now, there's a mixture of people retiring. Some of those people will come back, but on the aggregate, when you look out, you're seeing again those continue to dip, and it's all driven by the U.S. total fertility rate, which has come below replacement, which here is set at 2.1. So again, you're starting to see those pressure points really start to mount, and it just shows that we're going to continue to have that problem as we progress, which is why when you start talking about immigration and some of that replacement, it's important to make sure that we have, that we can close this gap. Now, turning to food, when you look at real food price index with oils, cereals, overall food index continues to flatline. And as we've been saying, we don't expect it to continue to go up at this massive rate. But remember, just flattening, just seeing this kind of standpoint. And then the food supplies from outside the Euro area have been impacted by the Ukraine, which we've been talking about multiple times. But if you remember, there was supposed to be a 4-way meeting held in Turkey about getting Ukrainian food out of their ports and into the market. And in true Russian fashion, the crop facilities were hit at the Ukrainian port, adding to the food issue. And as we've been saying, even if Russia-Ukraine came to some sort of an agreement, you still have the ports are mined. You still have how much damage was done to cranes, to storage, to silos. And here, when you look at sites owned by Bungie and Vitera, were struck on Wednesday's attack, and Russian forces fired at least 7 missiles at Mykolaiv, which is why now, and I have another slide of where that is. And as they continue to progress along the coast, and I think eventually they'll make it to Odessa, there's no way for this Ukrainian crop to come out, which will put more upward pressure because the futures were pricing in some of this normalizing. And you can see why, because the proportion of non-Euro imports from Russia, Ukraine, and Belarus is quite large. Maize, 35%, oilseeds, 17%, wheat, 8%. And now that's gone again. And that becomes a bigger issue. Same with fertilizer. So again, you're starting to see these shifts, which will put a bid back in some of it. Now, U.S. Weekly inspections, U.S. exported inspections last week fall in line with expectations. Corn was near the top end, wheat near the low end. So again, you're still seeing something pretty stable, but just at the lowest end of the curve. Now, just to give you an idea of what has happened in Ukraine, Russia right now, we're still at more of a stalemate. Russia has continued to make progress along the coast, as well as coming through the Donbass when you look at coming east to west. But in Kherson and in the north, the Ukrainians have made significant progress. And it's a mixture of the Ukrainians making progress and the Russians cycling down and adding troops along the coast, as you can see, continuing to move over. And when you look at the Mykolaiv position, you can see that 22% of grain handling ports are in that region. And so that's why damage there is, even if you start to get some sort of an agreement, how much damage is there? How many mines exist in this path? Can you get it out? And that's where we continue to see this a very unlikely outcome, at least before year end. So that's what we have for you on the global side. In the next segment, we're going to go deeper on the U.S. and how some of the things are shifting for the worse, and what does that mean, obviously, for the consumer.